The gentleman from Texas, Mr. Neugebauer, is.
Thank you, Mr. Chairman. Former Chairman. I want to go to this process of the Fed being a prudential regulator, and I go to this point, is that we've had a lot of people come in here. We've been for the last 18 months trying to find out who the boogeyman was and all of the calamity that's happened in the financial markets. And everybody that comes in said, well, it wasn't my fault. But I think the bottom line here is under the proposed structure by the House version or the Senate version. Basically, in many cases, the Fed had regulatory authority over many of these entities that, quote, people are saying was part of the problem. And so I guess the question I have is, if it didn't work before, how does it work now? And the second part of that is that, you know, these very large financial institutions, if you'd have gone into them, let's say 18 months ago, and said, you know, we're a little concerned about what's going on here. Well, they said, but you know what? We have record earnings. We're making lots of money. We have good our liquidity. We have good balance sheets. Our ratios are in place. What do you mean you want us to stop originating mortgages? What do you mean you want us to slow down our securitization activity? What do you mean you want us to get out of the credit default swap business? I mean, how did you miss it, and how would have you done it different? Because if you're not going to do it different, then we're moving down the wrong direction here. And I'll start off with Chairman Bernanke.
Well, that's the $64 billion question you just asked.
No, it's a trillion. It's multi-trillion dollar
question.
Yeah.
So there were mistakes and problems throughout the system. Other regulators and the Federal Reserve, private sector, and even Congress made mistakes in this crisis. And the only thing we can do is go forward and fix the mistakes. And we are working at every level. We are, of course, recommending changes to the overall statutory structure to address gaps and other problems in the system. But we are also taking action ourselves. We are strengthening our capital requirements, for example. Liquidity turned out to be a big issue in this crisis. We have been working internationally to strengthen that substantially. Executive compensation. We have also, and I think execution is very important, so within our own supervisory system, we have been doing a lot of soul searching and a lot of changes, and those changes are both at the level of this framework for supervision, which we believe needs to be more systemic, more so-called macro-prudential, but also in terms of execution. I mean, we found situations where, just like you described, where we weren't fast enough, we weren't forceful enough. We need to change our culture, our structure, and our instructions to examiners and so on to make sure that we do a better job next time. So everyone has to do a better job. We are working to do a better job. We think there are structural reasons, though, that the central bank needs to be involved in this process.
Chairman Volcker.
Will you comment on the same question? Let me make a general point. We have a lot of discussion about supervision and gaps and supervisory policies. Supervision is a tough job because you are dealing with a very complex situation with some known, some unknown factors in a political world where your tools are limited. You have to be able to explain what you're doing, which is very hard to take restrictive moves when things are going well. So I say don't put more burden on the supervisor that's necessary. They're very necessary. But if there's some structural factors in the market that you want to promote or eliminate, do it by legislation and not leave everything up to the supervisor, or give the supervisor a very clear framework within which to work. And the more you do that, I think the better off we'll have in terms of supervision.
I don't disagree with that, Chairman Volcker. I'm a less regulation person, but I think the point is we actually had regulation in place. We had regulators in place. And I think there's an unreasonable expectation here that somehow we're going to fix this. We have bank regulators today, but we've had over, 100 some odd banks fail. And the question is I think some people think, well, by expanding or reshuffling the deck, that we're going to have a better outcome. I think we would have had a much better outcome if we'd have had people that were doing the job that they were already supposed to be doing.
I can't deny that, but there were gaps in regulation, gaps in authority. One was large gaps in the investment banking area, in my opinion, where a lot of the crisis arose. You had gaps in the subprime mortgage. You had some regulatory authority over some parts of it, but none over other parts of it. So you had a big gap, given what we know now, and I keep coming back to it because I think it's important, in the resolution authority. There was no resolution authority there that gave the supervisors a reasonably effective, efficient way of closing down an institution with minimal damage. Now, that's something you've got to legislate.
The gentleman's time has expired. The gentleman